Hello and welcome to today's event. I'm David Brennan. I'm going to be discussing with everyone today about economic nexus problems that are facing clients and practitioners. And really, the gist of today's presentation will be a discussion of what economic nexus is to ensure that everyone's on the same page, what's been happening, what practitioners and clients can expect for going forward, as well as ways that clients and practitioners can mitigate exposure overall. As I mentioned a moment ago, I'm David Brennan. I'm one of the partners with the law office of Moffa, Sutton, and Donnini. By way of background, I used to work with the Florida Department of Revenue as a senior attorney there. My primary practice area in private practice is multi-state sales and use tax issues. Educationally, I have a double major in accounting and finance, my law degree, and a master of law in taxation as well. I also have a YouTube channel if you're especially a glutton for punishment. It's at Sales Tax Lawyer on YouTube. If you ever want to look back at this webinar or view others that I've done in the past, along with short clips too. So let's dive right into economic nexus. And in terms of a background, it's important to understand, as I mentioned a moment ago, where we were with respect to economic nexus to understand where we are and why we are where we are today. And to do that, we have to discuss a little bit of case law. I know it's dry and I'm so sorry, but we'll get through this as quickly and painlessly as possible here. So with National Bellis Hess versus Department of Revenue, it's more specifically the Illinois Department of Revenue. It was requiring the Illinois Department of Revenue was requiring a mail order company, National Bellis Hess, to collect sales tax in that state. And the Supreme Court ultimately held that, hey, the Commerce Clause of the U.S. Constitution prohibits the states, and in particular the Illinois Department of Revenue, from requiring the out-of-state company to collect sales tax on transactions for sales made into the state, even when the seller, National Bellis Hess, was not physically present in the state. They're located somewhere outside the state and were selling into the state. Fast forward 10 years, and we get another U.S. Supreme Court case, Complete Auto Transit versus Brady. In that case, the Supreme Court came out with a test as it pertained to whether a state could impose a sales tax on certain transactions for dealers that are located outside of the state. In this case, Complete Auto Transit was located outside of Mississippi, which is where Brady was. Brady, I believe, was the commissioner or executive director of the Mississippi Department of Revenue. And so the test that the U.S. Supreme Court came up with was a four-part test. One, the taxpayer has to have what's called substantial nexus with the state. In other words, some sort of connection to the state. Two, the tax has to be fairly apportioned between Mississippi and all the other states. Basically, it can't be duplicated. Three, there's no interstate commerce discrimination. If it's a discrimination against interstate commerce, remember, Congress has the sole authority, unless it delegates that authority, to regulate commerce. That's not delegated to the states. But if the state is trying to do that, it's struck down. And then finally, the fourth and final prong is that the tax must be fairly related to the service that the state is providing. So in other words, if the state's not providing any services whatsoever, which that I think is an easy hurdle to overcome if you're the state, then in that instance, the state cannot assess tax. So it's so easy that you can just say, yeah, we provide fire service or police service or you name it. And those are services that are provided, which would then allow that last prong to occur. About 15 years later was Quill versus North Dakota. I'm going to spend a little bit more time on this one since the case law that we're now experiencing springboarded off of and changed what Quill said. They backed off of it. But North Dakota was requiring Quill Corporation, who sold about 2 million of products into North Dakota. North Dakota was requiring Quill to collect sales tax on its mail order sales, catalog sales, kind of a lot like National Bellis Hess. Ultimately, Quill did not have a physical presence in the state other than, I believe, those catalogs potentially. And so the court came down and held, hey, in this instance, states, you've got to stop it. If a company does not have a physical presence in a state, then states, you are not allowed to require that company to collect sales tax for sales into that state. Plus, by the way, states, you have a use tax and people can just remit the use tax. And you and I both know that use tax and the sophistication of lay individuals who are not involved in tax, they might not have even heard of it and be aware of it. So the probability of uh, that actually being implemented is probably pretty slim to none, I would say, at the end of the day. But the court came down in favor of Quill and in favor of businesses. And businesses were elated by this. They're so happy, they're jumping for joy because really what this is a compliance issue. Businesses didn't have to worry about being audited by these other states because they weren't in the state. Businesses didn't have to worry about collecting the sales tax. Businesses didn't have to worry about charging the right amount of sales tax on the right products that might or might not have been taxable in the state. Maybe they were exempt. Maybe they were exempt at certain times of the year. States didn't have, or excuse me, the companies didn't have to worry about filing returns in the states either. So it was a huge compliance win for businesses to help keep their costs low. However, on the other hand, the states were not happy. The states felt a little grumpy, almost like how my kids were when they needed a nap. And so they started scheming and plotting and planning because this was revenue that they were losing out on that they could get otherwise. And the revenue would benefit their constituents. And even better, what politicians like is they could get revenue from someone and not have to worry about that someone voting them out of office. So you had all those factors going into states saying, we've got to find a way to be able to get these out of state companies to, quote, pay their fair share. And so the states, what they did before the most recent case of Wayfair versus South Dakota is the states started coming up with a whole bunch of different tools to try to circumvent Quill versus North Dakota. And that first tool that the states came up with was click through Nexus. So what does that mean? By way of example, if I am located in Florida, which I am, if I'm located in Florida and Amazon's not, and Amazon gives me a link and says, David, look, if you promote to your followers our products or Amazon in general, and they click your link and they buy through your link, we can track it and we'll give you a commission for all those sales. That's great. I do nothing other than promote it. Perfect. And I'm making money too. It's a win-win all around. Why wouldn't I do it? Well, in that example, the states would say that Amazon has Nexus, and specifically Florida would have said Amazon had Nexus with Florida. Even though Amazon in that example did not have a physical presence in the state, Florida would still say, look, you have someone in the state, me, who has a link, who is promoting your business to Florida customers. Therefore, you have click-through Nexus. And because you have click-through Nexus, Amazon, you have a sales tax filing responsibility. And by the way, don't worry, we'll help you clean it all up. We'll assess you tax, interest, and maybe penalties. And as long as you pay that and file going forward, everything will be fine. So that was click-through Nexus. Affiliate Nexus. So what that would do is when you have related parties that are affiliated, company A, company B, and company A has an employee in Florida, but company B doesn't. Company B could be locked into having a sales tax filing and reporting requirement with Florida based on affiliate nexus. And so it was another way to attenuate the physical presence standard by saying, yeah, even though I'm company A's employee, really company B has that employee in the state. And therefore, company B, you have a huge problem. But again, we're from the government, we're here to help, and we'll help you get things straightened out, which by the way, you can make that check payable to Florida Department of Revenue or whatever other state that might be there. States also started discussing about economic nexus. And though we'll discuss this a lot later, well, not a lot later, but later on, this is the impetus for what the law is today. And essentially at the 50,000 foot level, economic nexus says when I, as a seller, though I'm not physically present in the state, have a certain amount of sales into the state or a certain number of transactions into the state, so dollar amount or transactional amount, then I have Nexus and I have a sales tax filing requirement with the state. Therefore, I have an exposure that I need to get resolved. And this was the winning argument for the states at the end of the day. More to come on that later. We then have Marketplace Nexus, which actually is out there as well today too. Marketplace Nexus, think Amazon, think eBay, where the quote marketplace is bringing the buyer and the seller together to buy a product on the marketplace facilitator's website. So if I sell something on eBay, I have a listing on there, and someone might come on eBay, say, hey, I see the listing by David. I want to buy that item, and they buy it. eBay in that example would be considered a marketplace. And so the marketplace laws say that a marketplace facilitator or provider has nexus in the state for A, B, and C reasons, especially as it relates to economic nexus. Sometimes that is tied into the marketplace nexus provisions. And so your marketplace providers, even if they're not your Amazon, even if they're not your eBay, can still have a problem, especially if their marketplace sales exceed that economic nexus threshold. Though I'd say a minority of states apply the economic nexus threshold to your marketplace facilitator nexus laws. Use tax and reporting requirements. So before Wayfair, you'd have states, and the one that I'm thinking of is, I believe it was Colorado. Colorado had a requirement, very low threshold, that said, hey, if you make X amount of sales, dollar amount of sales into the state, or sell a certain amount, number of transactions into the state, you don't have to collect sales tax. That's fine. But we're going to make life a nightmare for you. You, the seller, now have to report to us at the end of the year. So by February, March, or April of the year following the reporting year, you, the seller, have to report to us, the state, who you sold items to, that person's address, and the amount that you sold to each person. You also have to provide a report to each person that you sold to of how much they sold. You have to include certain language on that report that says you might owe use tax to your home state. You also have to include language on your website and on your invoices saying you might owe use tax to your home state. But the states wanted to be reasonable, and they said, look, you don't have to do all that if you just simply register for and collect sales tax from your customers. You do that registration requirement, we'll make the notice and reporting requirements go away. The interesting thing about it is a business did challenge this notice and reporting requirement in federal court that covered the Colorado area, and the business lost. The federal appeals court sided in favor of the state, ruling that this was okay to do. Why? I have no idea, but I do know that it was allowed. And so the other states that were outside the jurisdiction of that federal appeals court started saying, hey, we've got a case out west that says we can do this, so we're going to do it. And they latched onto it right away. And sure enough, you have had a good number of states that require this, but they always gave the out to the business to just collect the sales tax and be done with it. Oh, and by the way, if the business didn't file those reports timely, either with the state or with their customers, there would be a penalty per report, maybe $10 or $100, which doesn't sound like a lot. But if you have a good number of customers, that can add up and be crippling incredibly fast for any business. So Wayfair comes along and gets sued by South Carolina. You heard that. South Carolina took Wayfair and many others to court to try to get their law passed. And in a nutshell, Justice Kennedy, who coincidentally retired immediately after this case, within a week or so, he's questioned the advisability of continuing to follow those older cases I mentioned earlier, Bella Hess and Quill, in light of later Commerce Clause jurisprudence, and quote, in view of the dramatic technological and social changes that have taken place in our increasingly interconnected economy. So basically, he was saying, we're going to change the law because we can, and that's that, and there's nothing you can do about it. And so they did. And so, in justification for that, he noted that there was significant revenue shortfalls in a lot of these states, which is true. Revenues were going down in the states, and the reason may have been connected to the internet. So what I mean by that is that if I'm a buyer and I can go online, buy the same product from company A or company B, it's marked for the same price, but company B charges me sales tax, whereas company A doesn't, then me as a customer, I'm getting a quote discount on the purchase through company A. So I'm going to buy from company A. Company A doesn't have a sales tax filing requirement. Therefore, company A can make the sale and arguably has a competitive advantage. And that was one of the arguments that was made, is that it's not fair that these out-of-state companies can undercut the in-state companies. But it works both ways. You, if you're in-state, can sell to those that are out-of-state, and vice versa. That's not the law. The law changed. So let's talk about this case and the implications of it to understand where we are now and also where we're going to be going for the future here. South Dakota, at the time of this case, did not have a state income tax, and they relied heavily on sales and use taxes for the vast majority of their revenue. I'd say most states probably are relying on sales tax for the majority of their revenue. And as Justice Kennedy pointed out, as internet sales have risen, so too have state revenues decreased. So an inverse relationship here. So because of this, the South Dakota legislature, I believe they declared an emergency and said, look, in light of this revenue emergency that's going on, we have to pass legislation to require out-of-state sellers to collect and remit sales tax, even though they don't have a physical presence in the state. And we all understand that's in contravention of Quill, because Quill was very clear on that issue. And so the South Dakota legislature said, look, even though Quill says otherwise, we're going to pass this law. And we're also going to pass another law that says we have the right to sue people that we think are subject to this law. And that's why South Dakota sued Wayfair. They sued Wayfair and several other businesses to get this determination, this declaration as to their law, and just kind of ram it through. So what this did was sellers of tangible personal property in South Dakota without a physical presence in the state were required to remit sales tax, just as sellers with a physical presence would, if, and this is a key if the seller's gross revenue from sales of tangible personal property in South Dakota exceeded $100,000 in a year, or 200 transactions or more in the same time frame. And so that was a minimum threshold designed to protect small sellers. My thought comment on that is, if I am a seller on Etsy and I make beaded jewelry, such as beaded necklaces and the like, maybe a bracelet, and I sell them for $10 each on Etsy. I sell 220 of them to South Dakota. That's not a lot of money. That's $2,200. But because of that Nexus statute, I now have a sales tax filing requirement in South Dakota. And that's a huge requirement for me as a small business, because my profit on those 220 necklaces or bracelets is not going to be that big. I would end up paying way more in compliance costs to purchase software or hire a CPA to do my sales tax returns. Whatever the case may be, my compliance costs are going to be way more than what it is in terms of just the amount of tax that's at issue here. And so South Dakota, notwithstanding that, went forward and said, hey, we're suing Wayfair and the others. South Dakota lost at their trial court and at the state Supreme Court level. In both instances, they said, we agree with Wayfair and the other companies. We agree with them that U.S. Supreme Court case of Quill versus North Dakota applies here, and the state does not have the authority. So the court, being a court, says, okay, everybody agrees that the state doesn't have the authority. We will hold in favor of Wayfair, etc. And so that's why Wayfair won and South Dakota lost in those instances. So then we get to the U.S. Supreme Court. The judges, they get together and they decide, we're going to say Quill no longer applies. They overrule Quill. And they say that the physical presence rule, both as first formulated and applied today, is an incorrect interpretation of the Commerce Clause, end quote. That Quill is flawed. It creates problems with the modern economy. And it was an extraordinary imposition by the judiciary. Basically, they're slamming the judges who came up with the Quill decision, which was affirming what those other two cases said. So in other words, 50 years of Supreme Court precedent was overturned in this one case. And the judge is saying that, hey, that 50 years of precedent kind of doesn't matter anymore. And they just got it all wrong for the past 50 years, the U.S. Supreme Court. But we know better, and we're going to change it. The judges also ruled that the South Dakota law is constitutional, that small merchant exception that I described to you earlier, under 100,000 or under 200 transactions, was okay. And it's great because it's not retroactive. So many states said that they would not retroactively apply this. They filed certain documents with the Supreme Court saying that they wouldn't do it retroactively, Florida being one of them. Florida did try to do it retroactively on a case that we had. but that's a different issue. And so the Supreme Court said basically that the South Dakota law is constitutional. The court did not say what would be unconstitutional. In other words, if there was a lower threshold that would be deemed unconstitutional, they just commented to say what was. And so, in light of that, we have what we have now today. So, there's some problems that are going to be faced by clients and by practitioners. And I know they're problems because it's what I see in our practice. So the states will sometimes send out a nice questionnaire. They'll send them to your clients. Clients will say, oh, I got this in the mail. What is it, CPA? And you'll take a look at it and you'll realize, oh, hey, well, the state's looking at you for potentially auditing you for sales tax, or maybe it's another tax type in the state. And here's a questionnaire that describes what it is that they want to look for. Now, this questionnaire, if the client is not registered, it can all start just with this type of questionnaire and or some sort of inquiry letter. Now, the questionnaire, it's not benign. It's looking for ways for clients to incriminate themselves or have their CPA incriminate the client and throw the client under the bus. So talk about potential exposure. If you as the CPA fill it out, there's issues. What the states are looking for in these inquiries is for whether the business has nexus for any tax type with the state. And so the business will be asked tons of questions. Hey, do you have any employees in the state? Do you make sales into the state? How much, by the way? Number of transactions, gross amount, things of that nature. One of the biggest problems I see are for clients that use Amazon's FBA or fulfilled by Amazon services. A lot of states will take the position that if I have inventory in the Amazon FBA facility that's located in that state, then I have a physical presence in that state. And if I have a physical presence in that state, then I'm liable for sales tax. The thing is, as a business owner, my records only go back maybe 18 months that I can pull from Amazon. But Amazon may be sending the states more data than that, more data than I keep on that issue. So the states may say, look, until you can prove that you don't have Nexus, we have to unfortunately assume that you have Nexus, but we wish you the best of luck. That is the problem. It's my thought process that just because one has Nexus, just because one has inventory present in the state through Amazon's FBA, that one does not have Nexus. And in fact, I have fought this many times with states. I had one that settled not too long ago within the past year. And in that case, state was saying, look, the inventory present in the Amazon FBA facility constitutes Nexus. And we said no for various legal reasons. And I think we do have the better argument in that scenario. So if your clients have inventory present in a state through Amazon's FBA facility or other similar warehouses, they might have a problem. And they can get that problem fixed. It won't necessarily be easy or cheap, but they can get it fixed before it becomes a crippling assessment for them. And that's the key, is that they get out ahead of it in most instances, rather than just waiting for the state. Because if they wait for the state, I can guarantee you that it will be way more expensive from them, just from not only the cost to defend that issue, but also the assessment that they're then fighting, because they're not in the driver's seat and they gave up that right just by waiting. So how do you respond to these Nexus questionnaires? Do you stay silent? I don't think that's a good idea. If you stay silent, or if the client stays silent and ignores that questionnaire, Bad stuff tends to happen. Usually what happens in those scenarios is the client just gets a whole bunch of estimated assessments for whatever tax types, sales tax, income tax, you name it. Staying silent really is not an option. Do they fill out the questionnaire? Maybe, but as we discussed previously a moment ago, that questionnaire, it's going to have other issues besides just sales tax laced in there that if the client steps on it the wrong way, it's going to be a landmine of an explosion for them. Or is there something else they can do? Sometimes I'll write a letter to the state that addresses what's in the questionnaire. And it's because that letter can more fully explain things than just a yes no questionnaire can explain. And sometimes that is the better solution for clients. If you are registered, there could be issues as well. One issue could be if the state decides to say, hey, we want to see if you have Nexus before you said you had Nexus with us. So same inquiry, just a limited period, perhaps. I have seen that happen. Client gets registered for January 1st of one year, and the state's going back before that to say, we think you have Nexus before then, and we want to audit you. And that these questionnaires usually, not always, but usually are the beginning of an audit. So just keep in mind that what you put on the questionnaire or what your client puts on the questionnaire could come back to haunt them for this. And so that could be an issue for them. You have to quickly determine the exposure as well. Determining the exposure is key to know exactly how bad it is. If it's 250 bucks, okay, that's not that bad. You respond and you're done. Game over. It's $250,000, maybe that's a different issue. And then you're going to have to think carefully about how to respond and also what to provide to the state. And so that begs the question, what do you provide to the state? Best answer I can give you is it depends. And it depends because every state's going to ask for different information, but a lot of states are going to ask for that questionnaire, maybe some sales data as well to determine whether you meet their economic nexus threshold and or to determine what your liability should be. And by your liability, I mean your client's liability. Statute of limitations. What is it? It's how far the state can go back to assess your client. If you don't file a sales tax return in a state, arguably the statute of limitations is open indefinitely. What gets the statute of limitations running are filing sales tax returns. That's why sometimes, even though it's a pain, it's better to file the return than not to file it. And it's problematic because the state, if you haven't filed returns for the past 10 years, and you should have, the state can go back 10 years to when you first had Nexus and impose a huge crippling liability ultimately. Despite proof to the contrary, some states will still go forward just because it's easier for the auditor to make an assessment and kick the can, honestly. I have seen that happen, and it is very sad for when certain people at certain state departments of revenue would rather kick the can and have someone else up the chain deal with it than they deal with it and get to the right answer on it. A lot of states will take the position that your clients are guilty until proven innocent. As un-American as that sounds, it's a reality of the situation, and it is something that happens. You have to prove, or your client has to prove, that they do not have Nexus. I don't think that's the way that the law reads, but that's a lot of times how the states treat it. When assessments are issued, usually they're going to include penalties. Not always, but usually. Some states have an increased interest rate as opposed to their normal interest rate. And that increased interest rate is, hey, we audited you, we caught you, we're sorry, we can't do anything. Here's your 18% interest rate. You can make the check out payable to the Department of Revenue of whatever state. Sometimes, believe it or not, they'll estimate the tax that's owed, even if you provide records showing that their estimates are incorrect. It sounds insane that these things would happen, but I note it because I have seen these things happen before. So even if your client had 50,000 of sales, the state might say, no, it was more like 150 and go with some other quote, third-party data, end quote. And that third-party data literally could just be making it up. So you get an assessment. Now what? What do you do? The assessment usually is not the end of the line. Usually clients, so long as they do so timely or so long as you do so timely, can file some sort of appeal or informal protest or some sort of intra-agency action against the state to contest the assessment. Every state's going to have a different process and timeline for how that looks like. Work with the appeals area, get them the information. Sometimes they'll just rubber stamp it. Sometimes they'll work with you. It really depends on the state that's at issue. Sometimes, though you file that quote appeal, the appeals officer will send it back to the auditor and say, auditor, you look at all this, tell me your thoughts. And then the appeals officer just defers to whatever the auditor says. So think about this. You give information to an auditor, the auditor says, no, I disagree, here's your assessment. Give the information to the appeals officer, who gives it back to the auditor, who says, no, that's the same information, it's still incorrect. And the appeals officer just takes a word without any independent review of the information. Almost sounds like a waste of time if you ask me. But this process can sometimes take months, maybe even years, believe it or not, to get through. It's not uncommon whatsoever. If you still disagree after the appeal, your client's not out of luck at that point. They usually still have further right to fight the assessment. Again, if it is done timely, that is the key. And boy, I would say that's potentially a malpractice suit in the making if you miss that deadline, because the states usually will not let you make it up, no matter what's going on. If you didn't receive the notice and you miss the deadline, I think that's a different issue altogether, and one that is worth fighting because it's a due process issue. So the process after the appeals area, it really does depend on the state that's at issue. Sometimes they have a tax court, that state tax court, where you can file it. For Wisconsin, it's the Tax Appeals Commission. For Alabama, it's the tax tribunal. Sometimes you have to go straight to court, which that court might be your administrative court or an actual formal trial court. And you can sometimes go to your formal trial court after the administrative route has been exhausted. Keep in mind, though, sometimes depending on what your client has available to them funding-wise, the client might have to pay some or all of the assessment to go to one of these later options. Maybe they have to file a bond in lieu of that. But I can't stress enough how much one has to pay attention to the deadlines here, because without paying attention to the deadlines and just going whenever, wherever, that's going to open up some major issues. There's problems sometimes even in litigation. Sometimes states are overly aggressive when it comes to litigating. They just want to assess and prosecute. They're using a prosecutorial mind, anyone and everyone, because remember, every business is guilty until proven innocent. Process sometimes goes quickly, or it could go very slowly. Depends on where you are, really. If it's usual formal court, process can take a year or more. If it's administrative court, usually administrative court can go faster. You have to know the rules of procedure and evidence in this. I've heard of stories, though I've never encountered it myself, where the attorney for the state has taken advantage of non-attorneys trying to represent individuals and ran circles around them doing it. And that was a major issue because the non-attorney was not familiar with the rules of procedure and evidence to fight this. If you don't know those rules of procedure and evidence, I would say you should not be involved in that process, and a licensed attorney should be involved. Some states, they'll still remain unreasonable to the bitter end, and they'll appeal it until the bitter end as well. Ultimately, clients have to be ready for a fight. The states are always looking for ways to boost their revenue and to take cases for trial left and right. Maybe not every case, but most cases, I'm sure they would be happy to if they had the capacity to take to trial. A lot of them don't understand the difficulties faced by businesses. Here's an excellent point. I was dealing with a collector a few months ago. The client was behind on their sales tax. The collector told me, just have them fire one of their employees and then they can pay all their sales tax that they owe the state because of the revenue that they're saving, or excuse me, the expense that they're saving on not having that employee anymore. I couldn't believe what I was hearing from that collector. But that's a mindset with which one deals with when one is dealing with the state. And I thought about saying something to the collector on that, how that wouldn't make sense and you and I would understand why, but the collector's not going to understand it or appreciate it. She wasn't of that caliber. You also have to be prepared for states to just kick the can to the next area. As I mentioned earlier, auditors might kick it to appeals, the appeals might kick it to the attorneys. And so then the attorneys are stuck with all the cases that no one wanted to be reasonable on at the beginning and get resolved. And that's a serious problem. What if you or your client miss a deadline? Depends on the state and where you are in the process. There's a possibility you could file in another form. So for example, you might have two deadlines. First deadline is for filing an appeal with the agency or filing in court. You miss the appeal deadline, so you still have the right to file in court, though I wouldn't recommend that a CPA file in court. You might have the opportunity to have the case reopened. Depends on why you missed the deadline. Maybe the notice is dated January 1st, 2025, but you don't get the notice until June 1st, 2025, 5 whole months later. It's not your fault. It's the mail's fault or the state's fault for failing to mail it timely. So that might be a way to get it, quote, reopened. Sometimes go to the taxpayer advocate. They're supposed to be in the taxpayer's corner and help. And I would definitely recommend that. Not every state will have a very zealous taxpayer advocate, though. Some will, and some will absolutely go to bat for you. The Florida one, absolutely love him. I think he does a great job. In all other cases, your client might be out of luck if it's done and the deadline has passed. You've got disgruntled clients, you may have a lawsuit for malpractice coming. That's why it's exceptionally important never to miss these types of deadlines because they do substantially affect the rights of clients. And what if the notice was never received? We did cover that just a moment ago. So, how do you determine whether someone has nexus in the state? It all starts with the statute. There's a ton of free resources that are out there. You get what you pay for, though, is the best way I can put it. So if you're not paying anything for it, the free resource might not be the best. But they're out there and they can help give you a general lay of the land. But really, it's going to come down to what the law is and what the law says. And the law is always more nuanced, generally speaking, than those free resources. But you have to determine the sales tax nexus threshold, which the starting point usually is going to be $100,000 of sales or 200 transactions. Now, there might be other tax types for which the client has nexus, and it might not make sense to do an analysis for every single tax type. Usually, the two most predominant tax types are going to be sales tax and income tax. The others, while they might be relevant, are usually going to take a back seat to those first two ones. You could and do, in fact, have different standards in different states. Some of them include all exempt sales. Some of them only include some exempt sales in their nexus threshold. Moreover, different states are going to have different thresholds. So you might have that 100,000 or 200 transaction threshold, or it might be 500,000. Generally, no states, though, are going to have less than $100,000 or 200 transactions of a threshold. So that's a good, very back of the napkin way to quickly determine whether a client has nexus in a state before looking into it deeper. Voluntary disclosures are an excellent tool for getting things cleaned up. The process can be complicated and convoluted, especially if you've never done it before, and just winging it in the state is not necessarily in the client's best interest. You really need to have an understanding of the process backwards and forwards and everywhere in between as to how it's done. But you have to be proactive. The moment the state contacts you and says, hey, we're going to audit you, then there's no more voluntary disclosure option. So that's why it's critical to get voluntary disclosures filed as soon as possible in the process. That's one of the criteria. One of the other criteria is sometimes, depending on the state, is whether another voluntary disclosure was done in the state previously. Another one that's not listed on there is sometimes the states will say, look, if you're already registered for that tax type in the state for which you want to do the voluntary disclosure, it's not allowed. So there's a lot of ways that the voluntary disclosure could be kicked out and the client could be disqualified. The Multi-State Tax Commission is a more efficient way to do voluntary disclosures, I find, rather than looking up the requirements of every single state. And it's something that I usually do recommend in general. How to determine which states to do? It's on a client-by-client basis. Some clients would rather just rip off the Band-Aid and get all states done. Some clients only want to proceed with some states at a time. I've got, I don't know how many different clients I'm doing voluntary disclosures for or am otherwise involved in, and they've all determined to do it different ways. Some starting with the states with their highest liability and working their way down. Some states where they're growing it and they want to get that state fixed. Some states they'd rather get quantity over quality. And what I mean by that is they'd rather get 10 small states knocked out than one large state. And the list is endless in terms of how they do it, but it just depends. If their sales tax collected not remitted, then usually penalties will be assessed, but the penalties will be less than what it is in audit in most cases. So that's an incentive in terms of helping the clients to come forward. It can also help to reduce the look back period, which if the client had its exposure for 10 years, then the look back period might be only 3 or 4 years. And that 3 or 4 years basically, quote, forgives the other 6 or 7 years of exposure. So that paired with the potential penalty abatement or reduction can be a huge incentive, along with ensuring that the client is collecting sales tax for going forward. That is key to mitigating their exposure. And of course, there's all sorts of other strategies that would be client specific that could be involved, but those would have to be shared at a different time. As I mentioned earlier, there are so many different weapons that the states use during these economic nexus analyses and audits. One is guilty until proven innocent. Sometimes they'll put a civil penalty on the business, or other times their owners. True story here. Had one case, it was actually in Florida here, this one, where a CPA referred the case to us. We were working on it. It was a collections matter. And the collector said, look, if the business doesn't pay this liability, then the Florida Department of Revenue is going to assess not only the owners, but the CPAs as well. Their rationale for assessing the CPAs was because the CPAs prepared the sales tax returns. Let that sink in. Merely by preparing the sales tax returns with the numbers given to them by the client, somehow expose the CPA. I disagree with that. I think there should be zero exposure in that analysis and in that situation. But what do I know? They could revoke or suspend the sales tax license, which basically puts you out of business in that state. They could block new registrations as well or require a bond. They could also transfer the liability to new buyers. Even though you sell only the assets of the company to a buyer, that sales tax liability can also be transferred as well. You might have criminal exposure as well, or the clients might have criminal exposure. So those are all weapons that the states could use. Now, where can you find the law? You can go to the state's Department of Revenue website. You can go to the legislature's website, the state administrative code, or court cases. You can also always call the state tax hotline, their generic 800 number or whatever the law is, or whatever the phone number is, excuse me. You're taking your life in your hands if you do that. And here's why. Two stories on that that I've come across. One is when I was at the Florida Department of Revenue, and this is a pretty much true story, but when I was there, I would get calls. As an attorney, I would be a specialist, able to answer calls for people, and they would have talked to 3 people getting 7 different responses. The moral of the story is you could pick up the phone now, call the state, ask them a question. 15 minutes from now, you pick up the phone call again, you get someone different, you get a different answer. So buyer beware in that situation. A very real example that we are hired on a number of times and quite frequently is when the client CPA or even attorney will call the state Department of Revenue and say, hey, what's going on? And they rely on that opinion, that oral opinion, which you can't, but they rely on it. Then the auditor comes and says, no, that's wrong. You need to do it this way. Even though you got that oral guidance from the state and you rely on it, or the client relies on it, it could be wrong. And you could get in a world of trouble. And that's things that we've had to litigate time and time again. That reliance on the oral guidance. Clients just want to do it right. And the easiest thing is to call the state. That's not necessarily the right way to do it. And so you've got to be very careful if you do that. If you discover you or your client have made a mistake, as I mentioned earlier, voluntary disclosures are the best way usually to get that cleaned up. There's other methods as well, but it could be the least painful solution to getting things cleaned up with whatever mistakes there were. If you have any questions, my contact information is on the screen. I take cold calls regularly from CPAs, attorneys, accountants, you name it, with questions. Hey, David, I've got a client in my office. Can you talk now? Happy to do so if I'm available, or responding to emails. I know how it goes that when the client reaches out to you, it's a 911 at that point. So I try to be as responsive as possible, but my contact information's on there. Feel free to call or to email me if I can be of assistance anytime. My YouTube handle is on there at Sales Tax Lawyer. If I can ever do anything, feel free to reach out to me. But thank you everyone so much for joining today's presentation. I truly do appreciate it. I hope you guys have a great day. Take care.